I'm now very pleased to introduce our keynote speaker on global economic conditions and opportunities for food and the agri-food industries. And I had heard this presentation before, and I got to tell you, it is a terrific, I'm setting the bar high for you because it should be set high, a great presentation. I'm sure you'll get a lot out of it. It's being presented by Doug Porter, Chief Economist and Managing Director, BMO Financial Group. Doug has over 25 years of experience analyzing global economies and financial markets. As Chief Economist, he oversees the macroeconomic and financial market forecasts and co-authors the firm's weekly flagship publication, Focus. He's regularly quoted in the national press and interviewed on radio and television. Before joining BMO, Mr. Porter held the positions of economist and country risk analyst with other Canadian financial institutions, and has also worked at the Bank of Canada. Mr. Porter is a member of C.D. Howe's Monetary Policy Council and also serves on the investment management committees of the Bank of Montreal's Pension Fund Society and Western's Endowment Fund. Please join me in welcoming Doug Porter.
Thank you kindly, Paul. Thank you for that warm welcome. It's indeed a pleasure to join you here today in lovely Guelph. So what I plan on doing over the next 30 to 40 minutes is basically going over the broad global economic backdrop, bringing that down to what it might mean for North America, Canada, Ontario specifically, and then what in turn that means for things like interest rates, the exchange rate, and your industry as well. And hopefully I can do that all in about 30 or 35 minutes. But before I get going, and I always like to do this, with your indulgence, I'd like to just conduct a quick straw poll and ask you whether you are optimistic, cautious, or pessimistic on the Canadian economy over the next year. And how I'd define an optimist would be somebody who thinks that things will markedly improve over the next 12 months, whereas a cautious person would believe that what we've seen in the last couple of years is about as good as it's going to get, and at best we're just going to kind of keep grinding along at very modest growth. And finally, a pessimist, in my view, is somebody who spent far too much time reading the Globe and Mail or watching Peter Mansbridge in the CBC and thinks we're in recession and likely to stay in recession over the next year. So with those unbiased definitions, how many people would consider themselves to be optimists? Any optimists in the room? Must be a few people here from Bank of Montreal. Okay, thank you very much. Actually, that's pretty optimistic, about a quarter of you. Okay, and said any cautious folks in the room? See, we have a few Canadians here. Okay. Pretty much the lion's share. Okay, and any pessimists? Anybody been watching CBC or reading the Globe and Mail too much? Not a soul in the room. Interesting. Just for your interest, I actually spoke to a convention or a conference of insolvency experts a few weeks back, and most pessimistic crowd I've ever seen. More than half of them, in fact, voted in the pessimistic side, and I told them that was the most pessimistic crowd I'd ever seen. And one of the gentlemen, and it was mostly gentlemen, came up to me afterwards and said, that actually means we're optimistic because that means business is going to be great over the next year. But the response you just gave me there is slightly more optimistic than I'm used to seeing. Usually I get about 90% cautious people and usually one or two optimists and one or two pessimists. So this audience is a little bit on the optimistic side, which is good to see. So when we look at the big picture, and by the way, it's not that surprising that we get a little bit of a mixed response in that question because we really are seeing a mixed picture when we look around the world. Now, I apologize if you can't read every single label up there or see every number, but the big picture is that we have some economies growing very, very rapidly. Up at the top of the heap, we still have India and China chugging along at 7% growth. And then we have this whole mass in the middle growing at modest growth rates. And then we've got some real laggards. And sorry, I can't point to that one because this tree is in my way. But then we've got some real laggards here at the bottom that are seeing outright decline. So it's a very mixed bag when we look around at the major economies. There are a few things I would point out, though, here. There's a few noteworthy items. First of all, for the first time in a decade, China is not at the very top of this list. For most of the better part of the last 10 years, China has absolutely been growing much, much faster than anyone else. Well, they've slowed. They've stepped down the ladder. For years and years, they were growing at 11, 10%, then 9, 8, 7, and now they're growing a little bit below 7%. And India's managed to leapfrog them. India is now the fastest growing major economy in the world. Make no mistake, whatever you hear, China is still growing quite rapidly. Yes, it's slower than what they had been growing before, still quite rapidly. Meanwhile, when we step down to the industrial economies, the next step down, I think this is a pretty representative picture of what's actually going on. Effectively, Britain and the U.S. are growing the fastest at a little bit better than 2% over the last year. Then we come down to Australia, Europe, Canada, and Japan in that order. Now, one thing I would point out here is that for the first time in a decade, Europe is actually growing marginally faster than Canada is. And there's some good news there and some not so great news there. The good news is Europe has actually quietly improved this year, and it's been one of the few regions in the world that has lived up to expectations in 2015. You know, there's been so much focus on the refugee crisis, so much focus on the Greek crisis, more recently, so much focus on the Volkswagen crisis, that, you know, I think some of this quiet improvement in the European economy has been overshadowed by all this headline bad news. You know, as recently as 2 years ago, Europe was knee-deep in a very serious recession, a second recession after what they went through back in 2008, 2009. And then we saw very modest growth last year, and this year they've actually improved. I mean, this is nothing to write home about, 1.5% growth, but it's a big improvement on where we've been in recent years, and that's actually about lived up to expectations for the European economy at the start of the year. That's the good news. The not so good news is Canada slowed to the point over the past year where we're actually growing a little bit slower than Europe. And as I said, that's the first time in a decade that Canada has actually been growing a bit slower than Europe. We think that's a temporary phenomenon, and I'll get back into that in a minute. Meanwhile, at the back of the pack, we've got these two laggards, half the BRIC economies that are now falling like bricks, Brazil and Russia, both in full-on recessions, just no doubt about it, for completely different reasons. Russia because they're an oil exporter, because they've been hit by sanctions, because they had to crank interest rates at the end of last year to support their currency. There's just no doubt about them being in recession. Brazil's been a little bit more of a surprise and a bit of a disappointment on that front. You know, of all the major economies, they probably hitch their wagon more closely than anybody to the industrial boom in China. Now that China's slowing, Brazil is suffering more than anyone. And Brazil, frankly, made some very serious macroeconomic mistakes ahead of their last election. They overstimulated things, and now they're having to reel it back at this point. Now, both these economies we think will not be as bad in 2016, so we actually see the global economy improving a wee bit in the year ahead. Now, just to put those numbers into perspective at the bottom right hand, if you can see them, a typical year for the global economy, for my money, is between 3.5% to 3.75% growth. So we've stepped down this year. We're below that metric. This is actually the fourth year in a row that the global economy will grow slower than its long-run trend. And we actually see that maintaining in 2016. We see a little bit below long-term average growth, even in 2016, and even with a little bit of a pickup in the overall global economy. But I would stress to you that that's not far below the trend. I mean, we are still seeing global growth of a bit better than 3%, so there are lots and lots of opportunities out there. You know, whatever you hear about the global economic slowdown, we're still seeing relatively moderate growth almost around the world at a wee bit better than 3% both this year and next year. Now, I do just want to talk about China for a second, because you do hear so many stories about the slowdown in China. And of course, there's a small cottage industry trying to estimate exactly how fast China is growing. Almost nobody believes their headline numbers. You know, every quarter, China is actually the first economy to come out with what they report on how fast the economy grew the prior quarter. You know, it's amazing for a population of 1.3 billion that they can generate their statistics faster than anyone else, and no one really, frankly, believes it. You know, the headline number is 6.9%. I've seen estimates as low as in the 3%. Some people do believe that it is growing close to 7%. Our own estimate is it's probably in the low sixes when we take all the available statistics together. But, you know, I think the main message there is, as I said, China is still growing rapidly. But I think the more important thing that's going on in the Chinese economy than what's going on with headline growth is the changing structure of the Chinese economy. To me, this is much more important. We are seeing right before our eyes a marked shift away from what has been what I call a heavy metal economy that depends very much on exports and business investment, and a shift to a softer economy, a shift to more consumer spending and services. And you can just see the share of the economy that's in manufacturing construction is falling very rapidly in China, and the share that is in the service sector, mostly consumer spending, is rising very rapidly. And that, to me, is not bad news for the global economy, this very important shift that's going on. However, it is bad news for heavy commodities. It is bad news for things like oils. It is bad news for things like metals. And that's why we're seeing a number of commodity prices probing multi-year lows because of this changing structure in the Chinese economy. It's not because of the slowdown in overall growth that we're seeing. It's this shift, this underlying shift that we're seeing in the Chinese economy. Now, that's the 30,000-foot level. Let's bring it down to North America. To me, probably the most important thing that's happened in North America this year is this divergence that we've seen between Canada and the U.S. In the last couple of years, Canada and the U.S. were growing like hand and glove. There was really no separation. For instance, in 2014, we both grew by, to the decimal point, 2.4%. This year, we've seen separation. The U.S. has actually improved a little bit to about 2.5% growth. Canada's growth rate has been cut in half. In fact, in the first half of this year, we actually saw an outright decline in Canadian output in the first 2 quarters of this year. And I can distill down to one word as to why the Canadian economy grew so much slower than the U.S. in 2015, and that one word is oil. We are a significant oil exporter. The U.S. is still an oil importer. So the U.S. actually does benefit a little bit from lower oil prices, even with the dramatic run-up in U.S. oil production in recent years. They are still a big importer, so they on net benefit from lower oil prices. We, like it or not, are a major oil exporter, and we are hurt by a decline in oil prices. And that's what basically, in a nutshell, is the reason why our growth rate was cut in half of this year, because of the oil shock. Now, it is already starting to fade. In the third quarter of the year, we saw Canadian growth come back to around the 2.5% level. We think the Canadian economy does better in 2016. We think it grows by a bit better than 2%. But it still won't quite keep pace with the U.S. because a few of the lingering effects of the oil shock, at least in 2016. And nowhere has this split between Canada and the U.S. been more obvious than in the labor market. And we just saw the numbers on Friday. The U.S. unemployment rate in the last few years has been cut in half. At its worst during the recession, their unemployment rate got all the way up to 10%. It's now come all the way down to 5% in just a few short years. Meanwhile, our unemployment rate, which never deteriorated as much as the U.S. during the recession, has largely been stuck at around 7% in the past year. So we're basically almost back to where we were a few years ago, where the U.S. was down in the 4s and Canada was around 6%. The U.S. unemployment rate is a full 2 percentage point below Canada's. Now, one thing I would point out is that these two numbers are not on an apples-to-apples basis. It's more like almost like apples to kumquats. It's actually much easier to be counted as unemployed in Canada than it is in the U.S. And if you corrected for that, Canada's unemployment rate would be about a point above the U.S. But there's no mistaking the trend. Look at that dramatic improvement in the U.S. in recent years, and meanwhile Canada is basically stagnant around 6%, at least for now. And again, that deterioration we've seen over the past year is mostly due to the oil shock. Now, turning back to the U.S. just for a minute, why are we still relatively positive on the U.S. when the U.S. is dealing with a strong U.S. dollar, when they're dealing with a slowdown in many of their major trading partners? Effectively, it's the U.S. consumer. We think the U.S. consumer is in a very good place at this point. They've really, really improved their finances. And just take a look at these charts. Look at the V-shaped nature of these charts. Consumer confidence after hitting the depths back in 2008, 2009 is all the way back to pre-recession levels. Auto sales, which back in the dark days of 2009, people said would never get back to normal. Well, they're back to normal. In the month of September, in fact, in the month of October, I should say, the U.S. had one of its best months ever for auto sales. They sold more than 18 million vehicles in the month of October alone. Not too many Volkswagens, admittedly, but they sold more than 18 million vehicles, one of the best months ever. We think this year may well be a record year for U.S. auto sales. And what's keyed this comeback in confidence in auto sales is job growth. The U.S. economy has added almost 3 million jobs in the past year, and that's really what's keyed the turnaround in consumer spending. And just as an added bonus, we've seen the big decline in gas prices. We've seen a decline in mortgage rates over the last year. So the U.S. consumer is in very, very good shape. Different story in Canada. As I said at the outset, I was joking about recession. Wasn't that much of a joke a few months ago. In the middle of the election campaign, it came out that Canada actually did see 2 quarters of decline in GDP at the start of the year. Everybody and his or her uncle or his and her aunt came out that day in the middle of the campaign and said, it's official, Canada's in recession. Everybody except for economists, that is, because that is just a rule of thumb, that 2 quarters of decline in GDP equals recession. That's just a rough guide. The official definition of a recession is a broad-based extended decline in output and spending. We have not seen that in Canada. What we saw was a very, very narrowly defined drop in output in Alberta and Saskatchewan in the oil and gas sector. The rest of the economy was not in recession. Ontario and Quebec were not in recession. BC was not in recession. If ultimately this period in the first half of the year does get counted as a recession in Canada, I am going to call this the best recession ever. Because what's happened in Canada this year is we've added over 100,000 jobs. We've had record auto sales of our own this year. We've got record home prices, and we've actually seen home building increase this year. So it would be a very bizarre recession. But why did the Canadian economy temporarily stall at the start of the year? Again, it was the oil shock. And just as a brief reminder, we went through 4 years where oil prices were $100 a barrel, and then within 6 months, they were cut in half, and they've stayed low. They've bounced around at that level, actually below that level. Just yesterday, they got dropped below $44, so they're still having trouble finding a base. Now, in many ways, oil was really the last shoe to drop in the commodity world. If you look back at most of the metals, for instance, if you look back at gold, silver, copper, nickel, they all peaked way back in 2011. A lot of the agricultural commodities peaked way back years ago as well, and have been working their way lower since. And there's really no mystery as to why commodity prices peaked in 2011 and have been coming off the boil since then. It's because of this underlying slowdown in the Chinese industrial economy that's been underway for 4 long years now. That's more than 4 years. That's what had undercut commodities. It really was chipping away at oil prices. We didn't realize that until the Saudis opened up the taps late last year, which led to that very deep drop in oil prices through the second half of last year. Now, looking ahead over the next few years, we do think that oil prices are close to stabilizing and that they'll improve a wee bit in 2016. We think they improve a bit further in 17, and then they finally hit their cruising altitude in 2018 of around $70 to $75 a barrel. That is well above today's levels, but it's also well shy of that $100 barrel level that we were so used to. We just believe the whole cost structure has been brought down so much in the oil sector. There's so much competition from green energy sources that are chipping away at demand that we just don't believe that oil prices are going to go back to that $100 barrel level, even over the medium term. Now, this has important regional implications for the Canadian economy. I touched on it a little bit before, but it's as if we're seeing the past 10 years get turned on its head. When you look at the last 10 years, there was just no contest. Way up here at the top of every single growth indicator was the oil-producing provinces of Alberta, then Saskatchewan, then Newfoundland and maybe BC, and then a step down to the other 6 provinces. Just to reiterate, there are effectively only 3 provinces that produce oil in meaningful quantities in this country. They are Alberta, Saskatchewan, and Manitoba. Alberta, Saskatchewan, and Newfoundland are the 3 major provinces. Manitoba actually does produce a bit, but they would rank 4th. So there are really only 3 provinces that produce oil. They produce more than 95% of all the oil. They had been the growth leaders. Now they're at the back of the pack. There's a lot of information on this chart. I would just direct you to the right-hand side. The right-hand chart. This is our estimate of growth this year by province, and you can see we've got the 3 oil producers all seeing outright declines. The rest of the country is still chugging along as if nothing happened. We're still seeing solid growth in all these provinces and drifting up, winning by not losing, are BC, Ontario, and Manitoba. They are now challenging for the growth leadership. Now, some might call this a race of the turtles. That's very slow growth that we're looking at, and those 3 are very modest growth. But it has been a long, long time since I've been able to say that Ontario will challenge for the growth leadership. In 2016, we see a very similar structure. We see everybody shifting a little bit to the right, but we would still have the oil producers at the back of the pack and central Canada and BC and Manitoba basically vying for the growth leadership again in 2016. The oil shock has also shaken up the provincial financial landscape as well. Ontario used to have the largest budget deficit in the country. We're now about average. Instead, we've been replaced by Alberta and Newfoundland, two oil producers that have the biggest budget deficits. Meanwhile, there are some surpluses out there. BC and Quebec are both looking at small surpluses. But the big story at the provincial level this year was almost every province saw a bit of restraint, whether it was tax increases or spending restraint. The theme in the provincial budgets this year was restraint. Now, neatly offsetting that, of course, is the federal government is in much, much better shape. Again, during the middle part of the election, it came out, lo and behold, that Ottawa actually ran a budget surplus last year, better than expected. And based on the numbers that we're seeing for this year, the new government is actually, despite what you may have heard on the news the other day, the government is actually likely to inherit a surplus for this year as well. And that, frankly, was good news for all three political parties. The fact that the federal government is in relatively strong shape, it meant that there was room to maneuver, that they could make promises that actually were affordable over the next few years. Of course, the victorious Liberal Party took it a step further. And I would say from an economic standpoint, the main feature of the Liberal victory is their plan to run up to $10 billion deficits. Now, for our visitors from outside of Canada, just put $10 billion into perspective, that would be about 0.5% of GDP. So we're going from a standing start of a small surplus to a $10 billion deficit. That would represent net stimulus of more than 0.5% of GDP if the Liberals do indeed budget that. I have not put that into my forecast yet because it isn't official. It was just an election platform. If indeed the Liberals do bring out this kind of very stimulative budget in the next few months, I would boost my forecast for 2016 by about 0.5 percentage point. It would give at least a 1-year bump to activity. Now, just to reinforce the point, most of that $10 billion is directed to net new spending. It's not a tax cut. They are talking about a tax cut for the middle income level, but that will be offset and paid for by a big increase on upper income taxes. So the tax regime will remain on balance roughly neutral. We're talking about $10 billion in new spending, about half of which would go to infrastructure spending. The other half, the pledge was to go to all kinds of different other social spending. Now, I'm not a political scientist, but just a couple things I would point out. First of all, I found the results to be absolutely eerily similar to what we saw in 2011. It's just that the names got changed around. I mean, look at the winning total in 2011 was 39.6% for the Conservatives. Liberals this time took 39.5%. Effectively, first place party won 40%, second place won 30%, third place won 20%. It's just that the names got all jumbled up versus 2011. The last point I'd make on the political side, and I'm not a political scientist again, is one question we're getting a lot is how are the Liberals going to finance these $10 billion deficits over the next couple of years? Well, I want to quash a rumor that's out there. The rumor was that Ottawa was going to bring out 3 new bonds. The rumor was that there was going to be a conservative bond that had no principal. Yes, this is a joke. A Liberal bond that had no maturity. And an NDP bond that had no interest. No truth to that rumor whatsoever. But by the way, somebody came up to me after I told that lame joke once and said, yes, there was a 4th bond, but it got blocked. Oh. So, back to my day job. So before the election, the question that we've probably been getting asked the most about Canada, and we get asked this question by foreign investors a lot, by American investors, by European investors, by Asian investors. They look at our housing market and they are absolutely convinced it's this giant accident waiting to happen. And the question we get is, will the Canadian housing market calm, cool, or correct? And our view has tended definitely to be to the one end of the spectrum. We believe that a lot of the concerns and the hand-wringing about the Canadian housing market have been overdone, and there have been a number of bearish calls over the years, dating all the way back to 2008, calling for a crash in the Canadian housing market, and the bears have been dead wrong. The surprise has been how strong the Canadian housing market has been, consistently strong. Now, I will say that that strength has been distilled down to fewer and fewer and fewer cities. It's basically become a story of an extremely hot market in Vancouver and Toronto and modest gains everywhere else across the country. It has almost exclusively become a Vancouver and Toronto story. What were already the two most expensive markets in the country have seen double-digit price gains again over the past year. Now, if you look beyond the two biggest cities, if you look at the next 20 biggest cities, say you look at the Guelphs of the world, or you look at Winnipeg, Montreal, Ottawa, what you see is much more calm story. Price gains of maybe 1%, 2%, or 3%. That's been the story across most of the country. Admittingly, in the oil-producing sectors like Alberta and Edmonton, we've actually seen outright declines or near outright declines in prices. They were the hottest markets in the country up until this year. They're now going into reverse. But just like Vancouver and Toronto are outliers on one side, Edmonton and Calgary are outliers on the other side. Now, looking ahead, I do believe both Vancouver and Toronto have become a bit overbaked. They are a bit overdone, and at some point, one or both of them will correct. But frankly, I don't see the trigger over the next year or two that would lead to a correction in these markets. We do not see an interest rate hike. We don't see a big slowdown in the flow of people to either one of those cities. In fact, one of the things the oil shock has done is it's diverted people away from Alberta back to places like southern BC or the GTA around Toronto. So there are actually more people coming into these regions than ever before. So while we do think Toronto is already starting to lose a little bit of steam, I don't see the features in place to lead to an outright correction in those markets over the next year or two. Now, of course, the flip side to those record home prices that we're seeing, especially in Toronto and Vancouver, is we continue to see household debt rise to ever higher levels in this country. And not only is it at a record high in dollar terms, it's also at a record high as a share of income. So famously, Canadian households now have more than $1.60 of debt for every dollar of income they have. That is an all-time high. It's also above our U.S. counterparts, which is very unusual. It's very unusual to have Canadian debt levels above our U.S. counterparts, and that's really what's got people wringing their hands, the fact that we do have higher debt levels than our American counterparts. But I would just, if there's something I can say to give you comfort on that front, I would just point out that Canada is not particularly high when we compare ourselves to other countries, other major industrialized countries. Let's just look at some of the economies that actually have higher debt levels, household debt levels as a share of income than Canada does. Denmark would be the world champ on that front. They have the highest household debt levels in the world, followed closely behind by the Netherlands. And I would say that what's the common element of most of these economies that have very high debt levels? I would say these are some of the most successful economies in the world. For instance, we have Switzerland, Norway, Australia, all very, very successful economies that have higher household debt levels than Canada does. And very similar to Canada would be Sweden and Britain. Meanwhile, take a look at who's on the right-hand side, who's got relatively low household debt. Lo and behold, the U.S. actually has below average household debt levels. I know we always think of our American friends as being spendthrifts who couldn't save a nickel if their life depended on it. That's just not a fair characterization. The Americans have actually done a very, very good job in the last 10 years of really repairing their household finances, rebuilding their savings and bringing down their debt levels. The U.S. household, and this just goes back to my earlier point about how strong the U.S. consumer spending outlook is. The U.S. household is actually, just to reinforce the point, is a relatively low household debt country. Now, looking ahead, the other question we get besides on the housing market and on the debt side is we do get a lot of questions about the Canadian dollar. And the question is, what's up with the Canadian dollar, or should I say, what's down with the Canadian dollar? Do you realize it was as recently as 2013, the spring of 2013, that we were still at parity with the U.S. dollar? We find ourselves today at 75 cents against the U.S. dollar. What happened? What fundamentally changed to lead to that 25% drop in the currency in the space of just a little bit more than 2 years? I would point to three fundamental factors. One is oil prices. Lower oil prices do affect the Canadian dollar, full stop. Whether we like it or not, again, we are highly dependent on oil prices. But I think a second big factor that's changed in the last couple of years is a lot of this weakness we're seeing in the Canadian dollar is just the flip side of a very strong U.S. dollar. The U.S. dollar is like a giant ocean liner. Once it gets moving in one direction, it tends to move in that one direction for years. And a couple of years ago, that ocean liner turned around and is now heading higher. And while it's been chopping around in recent weeks and months, We think that the forces that led the U.S. dollar higher in the last couple of years are still very much in place. With the U.S. economy doing better than most other economies, we think the U.S. dollar will continue to forge higher. If you were lucky enough to have traveled to, I don't know, Milan or Berlin or Paris this year, you would have found that your Canadian dollars went very far, because the Canadian dollar has actually held its own against the euro over the last few years. It's held its own against the Australian dollar. It's held its own against the Japanese yen. A lot of this weakness in the Canadian dollar, as I said, is just flip side of a strong U.S. dollar. Now, looking ahead, we see those two forces roughly balancing each other out. Still low oil prices with a bit of a comeback over the next year, and a still relatively strong U.S. dollar. The third factor that's been at play is we do have a newish central bank governor, Mr. Stephen Poloz, who took over in June of 2013. And just a quick review of what the Canadian dollar has done since Mr. Poloz has taken over. Two things you should know about Mr. Poloz. He was head of the Export Development Corporation for more than a decade. Before this job, he was born and raised in Oshawa, Ontario, home of the biggest GM, General Motors plant in the country. I think it's just safe to say that he has quietly welcomed this weaker Canadian dollar with open arms. He's much more sensitive to the plight of exporters and manufacturers in particular, the challenges that they face when the currency was at parity. And, I think he's much more comfortable with the currency around these levels. Now, looking over the next couple of years, we suspect that the Canadian dollar is likely to stay in this sort of range of mid to high 70 cents over the next few years. Again, it's very sensitive to what oil prices do, but we believe that the currency is likely to remain at this relatively low, and I would say competitive ebb for at least the next few years. Longer term, just to put a reference on it, I often get asked this question, what's fair value for the currency? I would say almost no matter which way you look at it, if you look at purchasing power parity, if you compare a basket of goods in Canada versus the U.S., if you look at relative labor costs, if you look at the long-run average for the currency, you come back to the same neighborhood every time, and that neighborhood is in the low 80-cent range. Around 82, 83 cents is what I would say is fair value for the currency. But just as the currency was way above that fair value for a number of years, it can also stay below that fair value level for a number of years as well. And this does have implications. This low currency does have implications. There are winners and losers. The winners are basically anybody who's got to compete internationally. The manufacturing sector wins, the tourism sector wins, the agricultural sector does, on net, win from a weaker Canadian dollar. The losers are basically the average consumer. We are seeing a little bit of upward pressure on Canadian inflation. When we look at headline inflation around the industrialized world, almost everywhere it is zero. And this is just a complete coincidence that Japan, US, and the EU right now all have zero inflation at this point, to the decimal point. Britain's the big outlier. They've actually seen a 0.1% decline in inflation over the past year. Canada's inflation, though, is a little bit higher. I mean, nothing to be concerned about. In some respects, that's ideal inflation at 1%, but we're markedly higher than the rest of the industrialized world because there's been a little bit of upward pressure on imported prices because of that decline in the currency. Now, let's just dig a little bit deeper and look at what's gone up and what's gone down in price over the past year. And I've highlighted some of the food price changes that we've seen over the past year. And in fact, a lot of the inflation that we've seen in Canada over the last year has been on the food side. Right up there for very special reasons, and this is a U.S. story as well, beef prices have been leading the way. If anything, they're starting to simmer down a bit, but they've been the leader. Meanwhile, vegetables and fresh fruit have both seen better than 8% increases over the past year. Some of that's due to the weakness in the Canadian dollar. Bread and cereal products have both risen by about 4%. On the flip side, we've actually seen a small decline in dairy products, a small decline in processed meat. I don't think that's got anything to do with that story about bacon causing cancer, but it's interesting that we've actually seen a decline in processed meat prices. Meanwhile, also on the inflationary side, a couple very important goods items there, beer and cigarettes, both seen gains of better than or about 4% over the past year. But when you add them all up, when you put them into the blender, you do indeed end up with overall inflation of 1%. Now, looking ahead, I would just stress that the Bank of Canada targets inflation at 2%. They were one of the first central banks to target inflation back in the early 1990s. And since they began targeting inflation, they've been very, very successful. Inflation has averaged almost 2% on the button since they began targeting inflation back in the 1990s. And I still think that's a pretty good anchor when you're looking ahead in terms of what to expect for Canadian inflation. Now, in terms of food inflation, we do have a pretty good leading indicator in this country. We do have the Farm Product Price Index. If we push it out a year, I would say that based on that alone, it looks like we'll see a bit of moderation in grocery price inflation. In the last 12 months alone, we've actually seen overall grocery prices rise by a bit less than 4%. That's actually a very strong rise that we've seen in the last 12 months. We still see a further gain over the next year, but based purely on underlying raw material prices, we would look at a bit of a slowdown over the past year. You can see it's not a perfect fit between these two indicators, but generally speaking, the underlying raw material prices do give you a relatively good guide to what the grocery store level prices are going to do. And we still see them rising, just not quite as quickly as they rose in 2015. Now, what does this all mean for interest rates, for financial markets? I think we're going to get a textbook case over the next year of why the Bank of Canada is not attached at the hip to the Federal Reserve. I think the general sense is whatever the Fed, whatever the U.S. Central Bank does, the Bank of Canada has to do. That is not true. We've seen the two deviate a number of times over the last 15 years. We think we're going to see textbook case of that over the next year, because we do believe that at long last, the U.S. Federal Reserve is going to start raising interest rates, quite probably in their next meeting in mid-December. This is not going to be anything dramatic. We think the Fed will only grind interest rates higher over the next year, but we do see a 1 percentage point increase in U.S. interest rates over the next year or so. And I would just stress that this is a very important development for financial markets. The Fed has been effectively at zero ever since Mr. Obama has been president. The last time the Fed moved on interest rates, George W. was still in the Oval Office back in late 2008, and there they have sat at effectively emergency low levels. Well, I think the emergency is long in the rearview mirror. As I said, the U.S. unemployment rate's been cut in half. The U.S. equity market is close to all-time highs. There's no emergency in the U.S. economy. It is high time for them to start raising interest rates, and we think that the U.S., as I said, will raise rates 4 times over the next year by a total of 1 percentage points. However, we think the Bank of Canada will do nothing over the next year. Earlier this year, the Bank of Canada cut rates twice in response to the oil shock. We think they're now happy with rates are, and we think the bank just stays perfectly flat through 2016. Now, based on our forecast for 17, and I didn't chart it there, we do see some further mild increases in U.S. rates. That's when we think, at long last, the bank will start to turn the corner in 2017, provided our relatively upbeat view on the U.S. economy does hold. We could see some interest rate hikes out in 2017, but again, that's more than a year down the line. This forecast will put some underlying upward pressure on long-term interest rates, but I would just stress to you that even by the end of 2016, even in this relatively upbeat environment, those are still exceptionally low interest rates that we're looking at by the end of 2016. Ultimately, central banks are not going to tighten too aggressively. If they're going to make a mistake, it's that they'll keep interest rates too low for too long and risk a little bit of inflation down the line. The last thing they want to do is cut short this recovery. They are going to be extremely generous. We've seen quantitative easing out of Europe, the European Central Bank this year. Mr. Draghi is actually talking about, if anything, even accelerating that, making it even more aggressive. The Bank of China has cut interest rates. I said the Bank of Canada cut interest rates. The big story here is just how generous central bank policies have been, and the ultimate winner from that has been equity markets. I started off by saying that, this is the 4th year in a row that the global economy is disappointed. It's likely to be slightly disappointing again next year. You would never know that by looking at equity markets. Equity markets have had very strong performances almost around the world in recent years, and even with that correction we went through in the summer, the markets are back mostly into the green again this year. We think they're probably going to have a fairly strong finish to this year, and our equity strategist remains relatively upbeat on the global equity market, especially the U.S. market, through 2016. The last topic I will touch on very, very briefly, and this is more just to set the table for the next session after the break, and that is just to bring it back to the European situation, the fact that we are looking at CETA over the next few years. I would just basically voice my total approval for the deal and suggest that it will set a much more favorable backdrop for European and Canadian trade. You can see that exports to Europe from Canada actually have stalled out a little bit in recent years. We're still seeing fairly strong imports into Canada from the European Union. Trade is relatively well balanced, it's slightly in favor of the Europeans at this point, but we do need a bit of a nudge because we have seen Canadian exports stall out. I'd also just like to point out just how strong the investment flows are between the two countries. We've got net assets in the country in both both economies have more than $400 billion, so the relationship is very, very strong, and I think the deal actually just strengthens that relationship that much more. That's it for the formal part of the presentation. I see I've left negative 6 minutes for questions. I'd be happy to take one or two at this point if there are any questions, and I'll certainly stick around later to take any other questions. Any questions at this point on any of those topics or anything I didn't go into? And seeing none, I will give...
There's a microphone over here.
Going once, twice. Yes, gentleman there. Sure.
Just wanting to know, do you see if the interest rates go up? Well, I know the banks have, as far as stocks, have been relatively low. Do you see the value of bank stocks going up? You being lower?
Yes, and of course I have to take off my BMO hat and put on my independent economist hat here to answer that question, since it's rather self-serving. Rising interest rates would be a bit of a double-edged sword for bank stocks. I mean, generally speaking, of course, they're a classic interest-sensitive play because of their dividend. They do generally tend to, as a stock, they do tend to benefit from lower interest rates. But we've gotten interest rates down to such a low level that the banks would actually benefit a bit from higher interest rates. In other words, the operations of the bank would actually benefit from somewhat higher interest rates. That's definitely the case in the U.S., by the way. In the U.S., you actually see the bank stocks rally anytime there's an indication that the Fed looks like they're going to raise interest rates. And there's just no doubt about it. They need higher interest rates in the U.S. To help support bank earnings. It's a little less critical, as I said, it's a bit of a double-edged sword in Canada. I would say the banks probably wouldn't be too upset with a mild interest rate increase in Canada. It would probably modestly help. But again, bank stocks, they tend to perform well when interest rates are falling, not rising. So it'd be a bit of a mixed blessing for the stock, for a typical bank stock at this point. In terms of why bank stocks are so low, by the way, it goes back to my earlier harangue on Canadian home prices. How there is just this huge body of opinion that thinks Canadian banks are short because the Canadian housing market is about to go off the cliff any day now, which has just been proven dead wrong year and year again. There's this one individual who I won't name, but he's now been calling for a 30% Canadian housing correction for the last 5 years. Meanwhile, Canadian home prices have risen by more than 30% over that time. I mean, he's going to get it right one of these days. It might be 20 years from now, but one of these days he'll get it right. But as I said, the bears have just been wrong, and I think they've been wrong on Canadian bank profits as well. Thank you for that question. Was another question right there? Yes.
Yeah, Rich Monkey from the University. Great talk. Thanks for
thank
sharing
you.
that. Back to our sort of focus here for this workshop. What's the bank's perspective on lending risk in the ag sector over the next 5 to 10 years? We have this incredible opportunity to exploit all of the natural resources and intellectual capital that we have in agriculture in this country, but we need the banks behind it to lend new development. So how do you view lending risk in ag?
Okay, so there's about 48,000 employees in the Bank of Montreal, and of the 48,000, I might be the least well qualified to talk about our lending policies. I have to, just as a bit of a disclaimer at the start, I'm an economist, not a banker. We actually have some bankers here, and I actually can't picture them. Oh, if you would like to add to any of my comments, but generally speaking, we are very positive on the agricultural sector. I talked about the weakness in commodities. Ag is a bit of an outlier, as is forest products, as are forest products. By the way, we're not nearly as negative on the near-term outlook on the ag sector. My former colleague Don Cox, who used to be a big picture strategist for the BMO, he was a pound the table bull on ag, and I still believe that a lot of what he believed were those big positives, long-term positives, are very much in play still. We've talked about the slowdown in places like China, but the reality is they're still growing 7%. You still got an enormous amount of people who are moving out of very, very modest incomes to medium class incomes or lower medium class incomes, and they are changing their diet, and we're still seeing that in play. And so, yes, it's been a tough year for crop prices this year, but longer term, from an economist standpoint, we would still be relatively bullish on the ag space overall. Would you like to add anything to that in terms of the lending policies at all?
From an operational perspective, we're being bullish on the agri sector. As number one agri bank in Canada and number two in North America, we
Thank you. Thanks a lot for that. Yes, gentleman back there.
Yeah, I have a question on the bank. I'd like to know what your view on agriculture lending is with the debt to equity ratios, and then how big a problem do you guys perceive the agriculture community not being replaced by the next generation? You know, like, that's what we do, we're farmers that are now 59 years old, and what I see in our area is getting bigger, the new people can't get in or aren't getting in, and I'm just wondering what your thoughts on that are.
Yeah, I can add a little bit to the second part. Again, I can't really help you with the first part. I'm not the best qualified to answer the first question. And it's a trend we are seeing across North America. That very point that farm sizes are getting more and larger, and it is just the relentless move to higher productivity. There's no doubt about it. I think even with TPP, if it does go through, you are going to see a lot of dairy farmers ultimately exiting the business as well. I think we're going to see the dairy farms get much larger, and of course that's been a relentless and dramatic trend that we've seen over the last 20 or 30 years. The average age of farmers has been rising very steadily. And I've been, by the way, I've been going to presentations for years that have been pointing to that, and how we do face this potential, I don't want to say tsunami, but this wave of retirees in the years ahead. But I think there will be at least a partial generation to replace them, and really the way we do solve that is through much larger farms as well. And as I said, that's been a trend that's been in place for decades. We might see a bit of a dramatic acceleration in that over the next 10 years or so, but it's, I think, as I said, it's something that's been in place for a long time, and we'll just see more of the same over the next 10 years, consolidation and expansion of farm size. Did you have anything else to add? No? Okay.
The bank look at that as a good thing or a bad thing?
I would say we'd be neutral on that. It's not something we can really shape or affect. Certainly from our end, it's just a reality that we have to deal with. I don't necessarily see it as a good or a bad thing. Unfortunately, we've run a bit over time, but I'd like to thank you again for welcoming me here today. Thank you.
Yes, thank you, Doug. Doug, don't go away yet. We do have a token of our appreciation. Thank you. Thank you. And on behalf of the group here, once again, thank you. Not only was it a great overview, I'm curious, your take on things, cautious, optimistic?
I'm cautious on Canada because of the oil shock over the next year. But if you ask me about Ontario or the U.S., I would actually lean towards the optimistic side. I think that actually Ontario is in some of its best shape that we've been in quite a while because of the better U.S. economy and the more competitive Canadian dollar.
Okay, excellent. Thank you. And it's a great segue also to the topic after our break. Oh, sorry. Absolutely. Please.